Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our June monthly market update. We hope to see many of you at our upcoming forum on July 13th. That's next week. We're hoping to have, as we had in April, over 100 clients attend. There'll be no shortage of topics as to what to cover, but we look forward to seeing many of you there. Some birthdays to celebrate. The United States, we hope you had a great 4th, 246 years young. And two things turned 15 this year. One you may recognize here is the iPhone. The other one is my youngest son, who's here in the white hoodie. So still a lot to cover. We'll try to break it down and keep this relatively brief. We're going to revisit this that we've talked about before, which is kind of the cycle of market emotions in the form of emojis, which talk about, at the peak of markets is when you're both euphoric, but there's also the maximum opportunity for risk versus the other side, which is very much kind of where we are now in between this panic, anger, kind of depression, that's the time of maximum financial opportunity, but both sides don't feel like it. They feel like the reverse, that this is the time of maximum opportunity. This is the time of maximum risk, but it's actually the opposite. So we have fresh jobs numbers, another very strong jobs report, almost 400,000 jobs added in June. Unemployment rate remains at 3.6. Wage growth was up. Participation rate ticked down a little bit. So we're still kind of in this tale of two economies, one through the jobs report and the other through, lowering growth and higher inflation. So as it relates to growth, this is growth over the last couple of years. This is kind of pre-pandemic and into pandemic, and then recovery quarter over quarter. The most recent read was 1.5, revised to negative 1.6. And we'll get an official reading on growth later this month to determine if we're in a negative 2 quarters of contraction, which most people describe as a recession. So this remains to kind of continue the tight spot theme. This car in the middle here would be the Fed, that's trying to both keep us from going into a recession and tackling white hot inflation. So as we kind of talk about the economy overall, it's worth looking at the components. So we're in a consumer-driven economy. Almost 70% of the economy is driven by the consumer. Again, the labor market's tight, so that's good for the consumer. This kind of tells us a little bit more about how the consumer is doing. So this is debt service ratio. So what amount of overall income is being spent to service debt? It has ticked up as rates have gone up, not surprisingly, but we're still well off where we were approximately 15 years ago. Also, in terms of excess savings, that has started to be drawn down, but it's still relatively high. And this is a data point that speaks to that. It's estimated there's about 2 trillion greater in savings account than pre-pandemic, even as savings rates have started to decline. So again, it does appear as that the consumer overall has some excess cash, but again, the extent to which that's deployed for inflationary reasons and for debt service ratio based on higher interest rates remain to be seen. So here's inflation with our most recent read of 8.6. So you'll see kind of where it was March of 21 versus now. It remains kind of a very high number. And again, it's the Fed's #1 priority to try to bring that down. Again, in that way, they both contributed to inflation, and now they're trying to steer the economy in a way that with higher interest rates brings inflation down. You're starting to see a term that doesn't go well together, much like a knife and electrical outlet are okay together. When you combine them, not good. So you're starting to see something called stagflation, which is just a slowdown in the economy combined with inflation. So clearly we're in a slower economy. Again, the final print in Q1 was a negative 1.6. Inflation stubbornly high. So whether we are in an environment where slow economy, high inflation, certainly indicates where we are right now. How long that remains to be seen. So the S&P we are in a bear market in the S&P 500, down approximately 22% for the year. These are the largest contributors. So you see a big disparity between IT and energy on the plus side. Some of the names that you'll recognize here, this is year to dates, everything from Tesla down 35 to Netflix down 70. Coinbase, dealing with crypto, is down 80. Facebook or Meta down 53. So a lot of the big tech names are in sharp decline. And it's the largest stocks that have done the worst in 2022. So by market cap, 1 to 5 on the S&P 500, this is what they're down: 6 to 20, 21 to 100, and 101 to 500. We're also seeing a huge disparity in terms of sectors, the highest disparity since 2000. And you'll see that here in consumer staples, consumer discretionary down 24, to energy being significantly positive at 58.5, an 83% disparity from January through the end of May. So again, that's the largest disparity of energy compared to consumer discretionary, or any two sectors, the largest since 2000. So we talk about this chart a lot. We talk about the fact that on average, the intra-year decline every year is 14. The intra-year decline this year so far is 24. Right now we sit at about down 21%. We zoom out a little bit, we kind of look to see where we were pre-pandemic, through pandemic, and where we are now. So the S&P sits at about 3,800. Pre-pandemic, we were just under 34. During the pandemic, we went down as high or as low as 2,200. We've also seen a tremendous move in interest rates as rates have gone in this 40-year bull market. We started the year at about 165. Rates are now up to about 3, which also means that bonds overall, especially the longer duration bonds, are down. And then kind of looking at historical bull and bear markets, I'll share with you some summary information in a second. This is obviously a lot of detail, but the bull markets are the blue, and the yellow are the bear markets. And kind of in summary, what you see going back to 1942, the average bull market lasts 4.5 years with an average cumulative return of over 150%. The average bear market, all of them painful, on average 11 months with an average cumulative loss of -32. Also, sentiment is a kind of ironically, bad sentiment is a good forward indicator. Going back to 1971, 50 years, and the 8 sentiment peaks, the average 12-month return is +4. The 8 worst sentiment readings, the average 12-month return in the S&P 500 was a +25. And then to kind of go back even further, talking about the S&P 500 from 1926 to 21, of those 96 years, 71 positive, 25 negative. The average positive return was almost 2 to 1 to the average negative. Again, all of these, though, painful to go through. So we did rebalance recently about a month ago. We talked about some of those themes dealing with more US energy and excess weighting to cash. We'll continue to update you in front of any changes that we make. So we'd encourage you to contact us if you have any questions. This brief commentary is no substitute for talking to us in person about how all of these things connect to you specifically. So with that in mind, we'll close. Again, we thank you for the trust and confidence that you place in us. If you have any questions, please let us know. Until we see you again, stay well and take care.